Hello everyone, my name is Aashish and I am the Managing Director and CEO for Motilal Oswal Asset Management Company. It's my pleasure to speak to our investors and investment advisors through this video today. Basically today I'm going to talk to you about investing in equity markets and more specifically about investing with Motilal Oswal PMS. The reason for addressing or the reason for wanting to talk to you today is especially keeping in mind the kind of challenging circumstances that we have seen over the last 1 year. Basically, what is interesting to note is that the last time the Nifty touched a 9,000 kind of level was way back in March 2015, and then for some time in July and August of 2015 we pretty much saw those kind of levels, and now again we are slowly and gradually inching towards 9,000 again. As we speak, we are more like 8,700 to 8,800 kind of range. In these kind of challenging circumstances, for over a 12 to 15 month kind of period, when you see the index go to 9,000, earlier this year in February 2016 we saw 6,700, and now pretty much back to 9,000. So what we've seen is that when markets are showing spectacular performance, we see a lot of inflows made by our mutual funds or our portfolio management services. Generally, when there are euphoric conditions, we see good amount of investments coming in, or a lot of investors wanting to participate. And it's only in hindsight that we come to know that those were euphoric circumstances. So for example, if someone told you in say March 2015 that 9,000 was the peak and you would see 6,700 in a space of 8 to 9 months, then you wouldn't believe it. Because on a lighter note, what we've seen is that when markets are going up, people expect them to go higher, and when markets are falling, people expect them to actually become half. So these are certain things which are, you can say, hazards of the investment world, and these are things which just cannot be predicted. But what we've seen is that whenever you see this kind of behavior in the market, when 9,000 becomes 6,700 and 6,700 again becomes 9,000, that's by any stretch of imagination, that is dramatic volatility. Now I'm going to construct my talk with that background or with that context. I'm going to keep my talk in two parts with you, because what I've seen is that when we speak to our investors or our investment advisors, clearly right now the world is divided between two types of people. The ones who have invested in the last 1 year when market has been really challenging, and the ones who have invested much longer or much before. The kind of considerations, the investment considerations and experiences for both these set of people are completely different. Because the people who invested much longer back in time, for those people 9,000 kind of becomes a benchmark, because people who invested a long period of time back, what they would think is that look, we saw 9,000 in March 2015, we didn't withdraw at that point in time, then we saw 6,700, and now again we are close to 9,000. So the fact that we have missed booking profits when it was 9,000 last time, let's take the opportunity of 9,000 this time. So that is one set of investors and advisors, that is one set of experience or one side of the story. The other side of experience or other side of the story is for people who invested around 9,000 last year. Obviously when you invested 9,000 kind of levels and you see 6,700, and now you are actually seeing your capital recovering. So for these kind of investors and these kind of advisors, the considerations are different. They would actually be thinking that we invested 100 rupees, the 100 actually became 80, and now that we are again getting 100 or 101 or 102, let's kind of take the money and escape. So for both of these kind of investors, or for both these experiences, this kind of dramatic volatility actually can change the course of our investment plans. This kind of volatility more often than not makes people forget what the original plan was when they really invested. So for all long-term investors, I would like to jog your memory and talk to you about a couple of points. We all have heard in the last few years, if you follow the folklore about the stock markets, we all have heard this dramatic example that if you bought 10,000 rupees worth of Wipro in 1980, then currently the value would be more like 600 crores or 700 crores. I'm sure all of you have heard this. And on a lighter note, if you haven't heard this example, then you need the right kind of friends on Facebook and WhatsApp, because it's been circulated all over the place. You've also heard examples of what Warren Buffett speaks. You've also heard, in fact, Motilal Oswal released a study a couple of years back, which actually says it's not only Wipro or it's not only what Warren Buffett says. There's actually a list of more like 45 to 50 companies whose share prices have appreciated more than 100 times in the last 20 years. And you might have actually seen Motilal Oswal as a company itself. We spend crores of rupees to advertise buy right, sit tight. That's because we genuinely believe that wealth is created by buying high quality companies and riding them through the entire growth cycle. So when this is the understanding, or this is the ethos of wealth creation, what we have always heard about or studied about. And this is what we set out to do. Most of our long-term investors who have stayed with us for more than a couple of years, they all understand that wealth is created over a long period. Just for example, if you were to refer to some data, despite all the volatility for the last 2 years, the CAGR on our value PMS is about 18% compounded. Instead of 2 years, if you take 3 years, 5 years, 10 years, for 10 years it's more like 25% compounded. Since our inception 13 years back, it's more like 26% compounded. So what happens is that we all understand that you need to buy right and sit tight. We all understand that wealth is created over a number of years if you hold on to high quality, high growth companies. But this kind of market volatility shakes up the best of plans. Let me also tell you at this juncture that 9,000 in March 2015 is not the same as 9,000 in August 2016, because in March 2015 you were fearful of another drought year. In March 2015 you were thinking that the government is not able to function, the land bill is under doubts, will the GST ever be passed or not, is the world coming to an end, is China going to go through a recession. So in March 2015 when you saw 9,000, there was a completely different environment. In August 2016 when you are seeing a 9,000 index, you are actually seeing that for few parts of the economy there has been a significant revival in growth. You are seeing that few pockets or few segments of companies are actually seeing higher and higher earnings growth. You are actually seeing that the GST has been passed and there is progress as far as the political logjam is concerned. You are also seeing that there has been a spectacular beginning to the monsoon season. You can see auto ancillaries, consumer goods, NBFCs, white goods, private sector banks. You can see variety of sectors actually delivering spectacular returns. So the limited point is that wealth is created over long periods of time. A short bout of volatility should not make you forget that you must buy right and sit tight. And like I just said, 9,000 a year back is different from 9,000 today. So do not let short-term volatility scuttle your long-term plans. That's the first part of what I wanted to say to you. For the other set of investors and advisors, who have invested exactly within the last 1.5 year, for them obviously the experience is slightly different. For a moment, if you allow me to use Hindi, I would say that जो असल नुकसान होता है वो नफ़े में नुकसान होने से अलग होता है. So I'm sure that you relate to these things in a different manner. But even if you've invested in the last 1 year, you invested 100 rupees, you've seen your 100 becoming 80 and now the 80 again coming back to 100. I would like to draw your attention to one simple thing, that at Motilal Oswal PMS, even when it was a year back or it is today, we are pretty much holding the same set of 15 stocks which we thought we had huge confidence in a year back. So in 1 year, while the index has gone through its own trough and regained its peak, we've not lost confidence, we've not lost conviction. As you can see, we've not made any dramatic changes to the portfolio itself. In fact, a lot of times what I would say is that when the market goes through huge volatility and you see your portfolio manager increasing the number of transactions, increasing churn in the portfolio, moving around or changing strategies in order to regain lost ground, that could be a sign of turbulence. Whereas actually at Motilal Oswal, what we've done is that in the last 1 year, we've actually held on steady to a set of high growth companies. Just to give you an example, quarter on quarter, the growth in the index earnings has been pretty much negative to zero. But every quarter through these turbulent times, for your PMS, the earnings growth has been in excess of 20%. Now, what happens is that eventually share prices are slaves of earnings. So I agree that in the last 1 year, share prices have not done much, but in the same period, earnings have grown in excess of 20%. So if the share price is where it was a year back, and in the same period of earnings have grown 20%, on an effective basis, your portfolio has become cheaper today. and it cannot continue to happen for any longer. The other thing you must always keep in mind is that when we are buying high quality, high growth companies, over a period of time, as earnings of companies grow, the share price tends to follow. A lot of these things you only come to know in hindsight. But if you're owning a high quality, high growth portfolio and you happen to invest when valuations are high or market is headwinded, then the market tends to postpone your return. Again, if you're in a high quality, high growth portfolio and you happen to invest when markets are tailwinded or valuations are cheaper, then the market tends to prepone your return. So if you see in the last 1 year, we have not done much in the portfolio. The only thing which has happened is that share prices have corrected while earnings have actually gone up. If you entered at 9,000 last year, for the last 1 year the experience hasn't been great, but what it only means is that to an extent your return has been postponed, but the earnings is not something which is getting postponed. So the idea is that in an investment horizon of 3 years, 5 years, 10 years, like people give examples of Wipro for last 30-35 years. I'm not saying one should invest for 30-35 years, but the whole point is that when you start off investing, you're investing for 3 years, 5 years, 7 years and 10 years, and in that journey the first 1 year is not something which is the deciding factor. For the first 1 year, if you don't make great return, it only means that you will get some return which is back-ended. There are a lot of times you get return early and then it tapers off or averages over the rest of the tenure. So when you're investing for a 3 year or 5 year tenure, there is no such condition that my return should come in the first 1 year or the last 1 year or somewhere in the middle. These are not things which anybody can forecast. The only thing that we must do is that we must remain invested and we must not panic when there is short-term volatility in the markets. The other thing that one needs to really keep in mind when investing in equities is that portfolio managers or fund managers like us, we are dealing with a game of uncertain outcomes. Whether it is share prices or NAVs, it's not something that we control. We actually don't control share prices or NAVs. So in a game of uncertain outcomes or in a game of probabilistic outcomes, where you can actually not control the outcomes, the only thing you can actually control is the input and the process. So like I said, we don't control share prices or NAVs. The only thing we control is the kind of companies we buy. And let me assure you that at Motilal Oswal, the kind of companies that we are buying are basically profitable companies who are making profits quarter on quarter and who are actually seeing their profits grow. So on an average, we are buying companies, the weighted average earnings growth on our portfolio is in excess of 20% year on year. So as long as we are buying profitable companies, the share prices will eventually have to follow the earnings. But coming back to the main point, whenever you're dealing with anything where the outcomes are not in your control, whether it's playing cricket or whether it is investing in the stock markets, when you do not control outcomes, the only thing you can control is the inputs, the processes. So we do not control share prices and NAVs, but what we do control on your behalf is the quality of companies that we buy and their earnings trajectory. So let me assure you, we are holding on to a portfolio of high quality, high growth companies. And if there is any change in the hypothesis that we make, we'll be first one to make corrective decisions. But as long as we are convinced with the growth potential of these companies, we will hold them on your behalf from a long-term perspective, and we will participate with you in the wealth creation. So these are a few messages that I wanted to share with you. Thank you very much for listening me out. If you have any questions, please feel free to write to me on aashishps@motilaloswal.com. That's AASHISHPS@motilaloswal.com. Thank you very much for listening me out. Bye right and sit tight.